Welcome to the 3-Edge Week in Review for the week of July 19th. I'm Fritz Folts, the Chief Investment Strategist at 3-Edge, and with me today here once again is Steve Cucchiaro, President and Chief Investment Officer at 3-Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing the Fed's potential exit strategy from their extraordinary monetary policy response to the onset of the global pandemic. But before we get into that, let's take a brief look at this week's activity in the capital markets. On Monday of this week, equity markets experienced a very risk-off day as investors debated whether we are now experiencing peak economic growth, peak earnings, and peak equity valuations. Monday's decline in equities came amid growing concerns, in particular in the spread of COVID-19 and the highly infectious Delta variant, and the prospect that yet another wave of the virus could threaten the current economic rebound and reverse the equity market rally that has driven stocks to new highs. However, the very next day, global equities rallied as investors turned their attention to strong corporate earnings reports and the continuing abundance of liquidity provided by the Fed's easy monetary policies. However, the bond market may be sending a somewhat different signal. During the equity market sell-off on Monday, the 10-year U.S. Treasury dropped below 1.2%, and real yields once again declined into deeply negative territory. The recent decline in the yield of the 10-year U.S. Treasury and a flattening of yield curves, not only in the U.S., but in other markets, such as Japan and Germany, may be indicating that the best period of global recovery could be behind us. Since then, the 10-year yield has actually backed up a little bit and now is trading about 1.3%. So now let's shift our attention to today's topic, where Steve and I will be discussing the Fed's eventual exit strategy and the potential risks associated with unwinding their current extraordinary monetary policies. Last week, Steve and I described the implications of the Fed's policies and described them as the grand experiment. And this week, we'll be discussing the Fed's exit strategy and the potential risk it could pose to the financial markets. When I was pulling together my notes for this week's video, I was reminded of the existentialist play by Jean-Paul Sartre called Huis Clos, which translates in English to No Exit. The play is a depiction of three deceased characters who find themselves locked in a room together for eternity with no way out. But I couldn't help thinking that, in some respects, maybe the Fed finds themselves locked into continuing to pursue easy monetary policy at a time when such policies really don't jibe with the situation on the ground in the economy or in the financial markets. But it seems as though perhaps the Fed believes that they cannot reverse course without significant risk and a negative reaction from the financial markets, which could translate into economic downturn before the economy has fully recovered from the pandemic. So, Steve, I will pose this question to you. Do you believe that the Fed may have painted themselves into a corner here and they don't believe that they're able to unwind their policy because of the risks that are out there? Is that the situation you think we're in now?
Well, while the recession ended over a year ago, short interest rates are still down at 0%, and the Fed is still printing money to the tune at an annual rate of over $1.4 trillion. So totally appropriate for an economy that's in a deep recession or a depression, not appropriate for an economy that is growing with rising inflation, well above average. So the Fed is actively discussing this exit strategy. Like you said, they've been held at this very abnormal, extreme circumstance for a very long time. But what's holding them back is they're fearful of tanking the markets, because in 2013 and again in 2018, when they tried to get out of the exit, get out of the stimulus back then, they did tank the markets. And the markets kept going down until they did something to reverse course. So they are fearful of that. We have a situation where in 2020, the stock market proved that it's more driven by Fed policy than by what's going on in the economy. For example, in April, the economy took a big dive into one of the steepest recessions in a long time. And yet the stock market soared that very same month, not having anything to do with the economy, but having everything to do with the Fed printing trillions of dollars and adding monetary fuel to the economy. So we can look at the reverse and say, well, what happens even if the economy continues to grow? What happens when the Fed goes for their exit strategy and starts to withdraw the stimulus? I think we could expect the market not to behave very well for that. Now, we have some meetings coming up that could present surprises and that could shake up the markets. The next one is next week, the Fed July meeting. And then in August, we have the Jackson Hole meeting, where often Fed has in the past made some major announcements that shook up the markets. And then we have another Fed meeting in September. So these are all opportunities for upsetting the markets.
Excellent. So I have a follow-on question, and maybe it's not so much of a question, but something that I want to understand better. And that has to do with the dual mandate that the Fed has. And the second part of that dual mandate is seeking to have the economy operating at full employment. And we know that there are currently, there are labor shortages throughout the economy, and yet many individuals have chosen not to return to work, at least not yet. And further, we know that, this has been hampering the economy's capacity to fully recover from the pandemic. But my question, I guess, is it doesn't seem to me that the Fed's continuing to pursue extraordinary monetary policy is going to be able to close that gap between the labor shortage and those individuals who have chosen not to return to the workforce. Could you comment on this at all? Am I seeing that correctly?
Well, Fritz, I agree that matching unemployed to the high number of job openings is beyond the Fed's scope. The Fed has a blunt set of monetary tools, and they're not really equipped to do that. That's more of a fiscal policy or more corporate policy. Other things are affecting that mismatch. And in fact, in the law of unintended consequences, further Fed stimulus might just create a greater number of unfulfilled job openings. So I agree that at this point it's beyond their normal scope.
All right, great. So if the Fed is in fact boxed in here a bit and not able to unwind the current, easy monetary policy, even in the face of the mounting inflationary pressure, do we run the risk of the Fed being behind the curve yet again when it comes to combating potential for material and longer-term increases in inflation? In fact, we haven't seen inflation for almost a generation at this point.
I think we are at risk more than most people realize. While there have been a couple of instances where the Fed or other central banks have acted prematurely, and they don't want to repeat those mistakes. When you look at history over the last century, many, many more times the Fed was behind the curve than the other way around. And this might be one of those times. Our model is suggesting that the Fed is already late in responding to the rise in economic growth and inflation. Professor John Taylor of Stanford, who is highly respected, developed the highly acclaimed Taylor rule, which is an algorithm that shows what Fed policy should be to keep inflation at bay, said based on his latest research, and we spoke just a few weeks ago, that to avoid persistent inflation, the Fed must stop all money printing now, and starting this quarter, begin to raise rates at the rate of 0.5% per quarter over the next 1.5 years. And that's certainly not what's in the cards. Housing costs are an example of unintended consequences of the Fed policy. The Fed still is buying $40 billion worth of mortgage-backed securities, plus $80 billion worth of treasuries. And all of this is creating ultra-low rates, which is creating asset and housing inflation. The housing inflation is thought to lead to higher and higher rents, which are already happening. And rents are often a more sticky form of inflation. So with a lot of unintended consequences, the Fed is chasing its own tail and causing part of the problem it wants to solve. So I do think that there is a higher risk that the Fed is behind the curve. there are people on the Fed committee who are making these same arguments.
Right.
So I do think it's important to watch closely what happens in the next few meetings. It could be a negative surprise for the market.
Interesting. I do remember that a little while ago, Fed Chair Powell said that the Fed is not behind the curve, which maybe means that they must be behind, they must be behind the curve. But anyway, so my final question is the same one that I asked last week about the Fed's grand monetary policy experiment. And that is, so if we're in this situation where we feel that the Fed is somewhat stuck, what is it that investors could do in this, potentially dangerous investment environment, where the Fed continues to pursue a monetary policy driving equity markets higher and increasing the risk of an eventual material correction in the markets?
So our research paints a picture of the US stock market as a rocket ship that blasted into space 15 months ago with all the monetary fuel that the Fed provided and all the investor exuberance and piling on the market and the fear of missing out, et cetera. And so one has to consider that once the Fed heads for their exit strategy, once they start to withdraw that extraordinary stimulus, yes, the rocket could fall back to earth. And so while it's so tempting to join the ride right as it's blasting forward, just like Sir Isaac Newton did back in the 1720 bubble before he lost all his money, we think it's responsible to stay diversified across many asset classes and to remember that no market in history has ever gone up more than 70% in a 15-month period without some kind of serious correction.
Excellent, excellent. Thank you for that. Those insights into this very important topic for investors to be aware of as we all chart a course through this extraordinary and perhaps dangerous period in the global capital markets. So that will do it for Steve and me. We'll be back next week with another edition of the 3Edge Week in Review. And you remember, all our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. And so until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.